Hi, Mike Almali, CPA Business Appraiser, back with this next time value of money video. In the previous video, we looked at bond pricing. In those cases, we knew with a fair degree of certainty the fixed constant interest payments, the maturity value, and the plausible range of interest rates to apply in order to set a price on a given bond. In this video, we turn to an application where there is far less certainty in future cash outlays and returns, and the interest rates to apply are far from obvious. Business owners and managers, as a matter of course, have to make important decisions as to how best to allocate strategically scarce dollars. Here is one example. A coffee shop owner has to replace the shop's commercial grade coffee maker. The coffee maker could be purchased outright for $20,000 or leased for a monthly payment of $387 per month for 5 years. Now we'll assume that the machine will last for precisely 5 years. In nominal dollars, the lease option will require $3,220 more than the purchase option. But of course, the timing of the payments varies. Under the purchase option, a full immediate outlay of $20,000 is required. Under the lease option, the payments are spread over 5 years. So in taking account of time value, how do we decide the best option? Well, it turns out that the best option depends on the interest or discount rate used to convert the future lease payments to a present value. This table shows the difference in present values as a function of the different discount rates. Now, as you can see, the net present value of the lease option is more expensive when we use a discount rate of 5% or less, but less expensive when we apply a discount interest rate of greater than 6%. At 6%, the options are equivalent. And this is no accident. In this example, I assumed the equipment dealer would want what is in effect an imputed interest return if the coffee shop owner chose to lease the machine rather than buy it outright. So in calculating the required lease payments, I used the mortgage payment formula amortizing the cost of the machine over 5 years of monthly payments at a 6% annual interest rate or a 0.5% monthly interest rate. But from the standpoint of the coffee shop owner, what is the correct interest or discount rate to use in evaluating whether to lease or buy the machine? The answer depends on the options available to the owner. If the owner has no funds to buy the machine outright and cannot borrow the funds to buy the machine at any reasonable interest rate, then leasing is the only viable option. But what if the owner has the cash on hand to buy the machine? Well, here we invoke the concept of opportunity cost to guide us. We simply compare the rate of return that could be earned with the funds on hand with the rate of interest imputed in the lease option. If the rate of return on the available funds is less than the imputed interest rate on the lease, then take the buy option. If the rate of return is greater than the imputed interest rate on the equipment lease, then take the lease option. But how do you figure out the imputed interest rate on the lease if the lessor has not openly stated it? Well, we can go back to our mortgage payment option and then solve for I, the interest rate. Here's that formula. We can then try to isolate the interest term on one side of the equation, but this leaves the following mess that you can try to solve by guessing and checking. Or you can just use an Excel spreadsheet formula like rate, which just requires that you enter the present value of the leased asset, the lease payments, and the number of payments. Applying this formula would yield the 6% annual interest rate, which is, of course, no surprise because this is precisely the interest rate I used in coming up with the $387 monthly payment. So if the coffee shop owner makes less than 6% return on her available funds, then she should buy the machine outright. If the owner makes more than 6%, she should lease the machine. Now I should note that I am ignoring income tax effects because interest expense is tax deductible. But if the interest earned is also taxable at the same rate, then we can ignore these effects. Of course, there is another option. It may be possible to borrow the funds to buy the coffee machine at an interest rate lower than the imputed interest rate in the equipment lease option. Again, though, it is important to compute the imputed interest rate of the lease payments to make the wisest and most rational choice. Now, there's another type of capital budgeting problem that business owners and managers frequently encounter that is a bit more complicated than figuring out the imputed interest rate on an equipment lease. Often an established business will consider starting a new product or service line. In these situations, the new product or service often is not forecast to be immediately profitable. In fact, for the first few years, there's likely to be net cash losses, followed hopefully by a number of years of net profit. As an example, suppose the profitability projection for a new product line looks like this. This is the cash flow forecast in the non-discounted form. In other words, these are the non-time valued nominal values. Now, how should the business decide whether to go ahead with this new product? We can see that, as in the case with the equipment lease, that the value attached to the project will depend quite literally upon the rate at which we discount the cash flows. You can see the lower the discount rate, the more valuable the new product appears. So again, what is the correct or rational choice here? Well, as in the equipment lease problem, this will depend upon the alternative uses of capital available to the business. In this case, the business will have to invest $16,000 over 2 years before it yields any profit at all. So the choice of discount rate will depend upon how high a rate of return the business could achieve on an alternative use of $16,000. One easy rule of thumb is to insist that any project have a discount rate greater than the business's cost to borrow funds. So if the business's borrowing rate is, say, 5%, then use this rate. In this case, using such a discount rate yields a positive net present value, so the business would decide to introduce the new product. Unless, of course, there were alternative investments that would yield higher present values using the same discount rate. Now, there's another time value computation that is often used in these kinds of capital budgeting decisions called the internal rate of return, or the IRR. This computation shows the rate of return that brings the net present value of an investment precisely to zero. Using a built-in Excel function shows the IRR in this example to be 10%, which with rounding equals the 0 point we computed utilizing the net present value computation. Generally, if the computed IRR is higher than the firm's rate of return on alternative investments, then the firm should go ahead with the investment. I realize this is somewhat counterintuitive, but as you saw in this table, the lower the rate of return available to the firm for alternative investments, the lower the discount rate used and the higher the present value of the investment income stream. Now, I suggested that using a firm's borrowing rate is the best measure of a business's opportunity cost, and that this is the rate that should be used for discounting forecast cash flows. Many would argue that the opportunity cost should be what is known as the weighted average cost of capital, or WACC. As the name implies, this measure is a weighted average of the cost of debt and cost of equity. The problem with this approach is that it is not very clear how to measure the cost of equity, although there are whole industries devoted to this endeavor. Most such endeavors try to construct seemingly reliable indexes that in the end are not that reliable at all. So click here for the next time value of money video.